because some have been surprised by the little impetus that's been provided by Abu Dhabi stepping in to grant that $10 billion loan to neighboring Dubai. I mean, it really hasn't been to the extent that maybe some people were thinking. Have you been surprised by market reaction to that?
I've been surprised that they've helped at all. I think most of the market was surprised. If you just look at what the credit ratings and what the credit default swaps did, credit defaults that when you buy insurance for the bonds defaulting at the end of the day, and the credit default swaps were pricing in that they would get no help at all, and it strengthened by about 35% overnight when Abu Dhabi announced the $10 billion bailout.
Yep, but yet market reaction has been pretty muted to that. So Asif, let's bring you into this discussion. I mean, what does this say about the mind of the investor? Because when that Dubai debt crisis came to the fore, we saw markets pretty much tanking, and now little recovery. It's been pretty muted trade as we've seen it play out.
My view was when it hit the news wires at that point in time, I certainly had the view that it would have been priced in. A default was expected at some point in time, and the reason why is that a couple of months ago, a year or so ago, probably for the last 2 years, some of the Dubai companies, government-owned companies, have been significantly overpaying for assets. So it wasn't too surprising from my personal perspective. I'm a bit surprised that the market didn't expect that to happen. But the one thing that you've got to remember, that the default in Dubai is small relative to, if you look at what happened in the United States in terms of the losses and on mortgages in the US and loans to consumers in the US. That's been massive and very big, and there's been big bailout money to support that. So I'm certainly of the view that the Dubai crisis was small relative to the big financial crisis that we've had over the last 18 months or so. So the market reaction, as expected, would be muted because a lot of the bad news, or the market wasn't pricing in bad news.
Well, given the fact that it has been a small situation compared to the US, we've also had the fact that US economic data has largely been overshadowing. I mean, since we left on Tuesday, we've seen the Fed come out as expected, leaving rates near zero, reaffirming that rates will be left low for some time, and remaining pretty optimistic about the US economy as a whole moving forward. So that largely overshadowing anything else. So let's get your view on the US economy and where you expect it to go as we head into 2010.
Well, if you listen to what the Fed had to say yesterday, everybody expected no change in interest rates, and that's what we got. But what was interesting was the view on the economy going forward in the US, and which was actually very positive from the committee, and that is actually what led to the strengthening in the dollar. The dollar sitting at 144 this morning. I think it's close to a 3-month high now, and you've got the fundamentals for the dollar strengthening at the one side, and you've got sovereign debt raging in Europe at this stage. You're looking at Spain, Ireland, and Greece has already been downgraded. If one or other two of the European economies' sovereign debt gets downgraded, then you would see the dollar much stronger than it is now. What's interesting is that the market hasn't really sold off with the stronger dollar. I would have expected, a lot of commentators talking about a carry trade reversal. We haven't seen that. The market's not really coming back that strongly, and only thing is the dollar is holding back the market now. The market wants to go higher.
Let's take a look at that dollar strength, though, Asif, with you, because certainly the rhetoric out of the Fed has been supportive, together with data showing slowing US job losses, improving consumer confidence as well. But we've heard before that dollar strength at this stage of the game is unlikely to be sustainable. Your view on the dollar position moving forward?
Yeah, my view is I think it's more of a technical strengthening of the dollar index at this point in time. What has been happening in the United States is that the economic data that's been coming out has generally been surprising on the upside. The other is the markets, interestingly, the futures markets on the FRAs in the United States, they in fact are starting to price in a rate hike sometime next year, although the Fed has come out to say that they'll keep rates on hold. I am of the view that the Fed has really done a lot. They've to try and stabilize the economy. The fact that they're keeping interest rates close to 0 or 0.25%. More and more will push investors to move out of risk-free assets into more risky assets, because the yield on risk-free assets is just so low. It's in fact costing you to stay in the risk-free assets. I'm not too certain whether the dollar strength will stay there, but technically in the short term it looks like it could go a bit stronger. Longer term, I would probably expect it to stabilize at current levels.
Well, for now, it's certainly helping Japan's exporters. As I was saying earlier, it's what lifted the Nikkei into positive territory today. But most banking shares seem to have taken a breather after yesterday's performance. I mean, this on a report, Asif, that global banking regulators are eyeing an effective delay in the implementation of new capital rules. What are you making of that news that's hit the markets this morning?
Generally, the scenario for banks generally, whether it's locally or globally or US banks, is that it's going to be a bit more difficult for them to earn excess profits over the next few years. We've gone through a terrible crisis, largely caused by over-leveraging, and this is by the banks more than anything else. Significant over-leveraging. We've got 40 times capital. The US government and the ECB and other central banks and or governments have been very concerned about this, and what they are doing currently with legislation is trying to rein that in. They've also trying to limit leverage to not more than 10 times banks' capital, and I think that's good for the long term. It's good for economies, so to try and prevent the excessive risk that has been taken. They've also clamped down on bonuses. That's partly been the encouragement for the excessive risk-taking. I think it's good for the economy, global economy, and for markets in general. Possibly that's part of the reason why bank shares have taken a bit of a knock, but I don't think it's going to persist in the longer term.
Well, let's bring it to you, Drikus. I mean, we've seen the UK propose tax bonuses be taxed, and while South African banks have certainly not been as reckless, there is this fear that we may well see that starting to filter through to home ground as well. Do you see that coming to the fore at all?
Not really. Our banks have paid it safe. A lot of commentators have reiterated that a lot of times. When you talk about tax, that's a different issue. Tax in the Western world is going to be a huge problem for the next decade. They've got huge, especially in the UK economy and other European economies, and that's especially a place to start is in the banking sector. Locally, we still got banks with good capitalization rates, and they've written off a lot of, they've made a lot of provision for bad debt the last 3 years, and I'm actually very optimistic about the banks. I think they've hit a throw, and I think over the next 3 years, if you just look at Standard Bank, for instance, you see a 5 Rand to 5 Rand 50 earnings per share recovery only in the reversal of provisions for bad debt. And at 11.5 PE, you're adding 65 Rand to the share price.
Well, you're certainly optimistic about the banks moving forward. What about resources? I mean, given the fact that we have this optimism about the global economy, we've got dollar strength coming to the fore. Maybe not sustainable, but certainly positive news for now for our resources sector.
Well, it's largely a dollar story at this stage. It depends on where you see the dollar going. Further weakening dollar again, if you see the dollar at above 150, then I would expect a much stronger resources market, price-wise. But just looking at demand, forget about the price, just looking at demand, China's restocked tremendously. You've got the PMI figures in the US above 50 now. It's not going to go much higher than this. We're not seeing a huge V-shaped recovery. Where's the marginal demand going to come from? Where's the extra buy going to come from to push copper 10-15% higher over the next 6 months? So where is the marginal buyer going to come from to push platinum to $2,000 again? I'm not seeing that happening anytime soon.
Your view